Joining us now with more reaction, Ritholtz Wealth Management CEO and a CNBC contributor, Josh Brown. JB, it's good to see you. What now? Where do stocks go from here, do you think?
I wouldn't be surprised if we have a similar outcome as what we had during the last Fed meeting. If you recall how that went down, CNBC's Steve Leisman asked the fateful question, were you considering 75 basis points after a 50 basis point rate hike? And the chairman demurred, and the stock market took off to the upside. Today looks like a similar setup, not as big of a rally, but certainly being led by some of the trashiest, highest multiple, scariest former growth stocks imaginable. Those were the leaders today. Never a great sign. And tomorrow, there could be a really big rethink. And I can't imagine that the bear market we've been in now, which is the 9th longest in the last 80 years in the entirety of the post-World War II history of the stock market, this is now the 9th longest bear market. It's hard for me to imagine it ends with a Fed rate hike of 75 basis points. So I don't think we've seen the lowest prices that we will see. And I don't think much really changed today, given how rapidly the bond market had already gotten here before the FOMC had its chance to put out a statement.
So what changes the game then?
Nothing. You probably need a recession. I don't think you can wring the amount of stimulus that's been put into this economy over the last couple of years out with just like a soft landing where everybody gets a happy ending. One of the questions I would have asked Jeff, and I guess I'll ask him some other time, but I would ask, as a bond manager, is now the time to shift from being worried about duration and that being the biggest risk to credit? And I generally think the answer is yes. We haven't had an environment where anybody had to worry about the solvency of really anything or anyone, whether we're talking about municipal governments or we're talking about newly public companies or we're talking about fallen angels. There's really been nothing to worry about, and spreads have reflected that. That seems to no longer be true. And this is not just going to be a U.S. phenomenon. In Europe, they called an emergency ECB meeting to look at what was going on with southern country bond yields. I don't know when the last time was that we had to worry about that issue, but now Italian bonds relative to German bonds of the same duration, we're seeing spreads widen, and that often is the precursor to a lot of headlines in the Financial Times, the Wall Street Journal. So if we have to pivot now, let me finish the thought. If we have to pivot now to this new risk, so look,
right, I think he answered that in terms of looking for something. He's expecting something. I think something to blow up, someone to blow up. As a result, when I asked him about this idea that central banks are not going to be able to do QT to the degree that they want to or at the speed that they think they can because of credit spreads widening, and he fully said to that question that he expects something somewhere to break.
We had about 1,500 companies come public over the last 2.5 years, and a lot of them were not built for a world where there's a cost of capital, and it's a positive cost of capital. They're not built for that. Our present housing market is not built for what's gone on in the mortgage market. In just the last week, things have gotten so extreme that purchase applications have crashed by 40%. Compass and Redfin, two of the largest brokerages or brokerage platforms, announced proportionally pretty big layoffs. There's a whole leg down in housing that could occur that would have significant ramifications for the economy. And that's notwithstanding the damage that we've already seen in equity market capitalization. You've got over $9 trillion in losses for the U.S. stock market. I don't think that's been felt yet in the real economy. There's a lag from a negative wealth shock like that, but it's coming. So this is where we are. I like the idea that stocks will have these temporary reprieves. They shouldn't go down 5 days a week, of course. And some stocks might be done going down, period. But it's going to be a difficult environment. The Fed is not in a position, Judge, to supply us with a new bubble to get excited about. Think about how many bubbles we've had come our way to enjoy over the last few years. The FANG bubble, the growth stock bubble, the SPAC bubble, the crypto bubble, the venture capital unicorn bubble. It's been one amusement park ride after another. The Fed just can't do it right now. They can't supply us with one. And that's why I think boring stocks are going to win. I think companies that are high-quality balance sheets, fortress balance sheets, if you will, companies that have pricing power, that have the ability to raise prices. I think dividend payers over non-dividend payers show me the cash flow. And I think return of capital is the new byword. And return on capital becomes significantly less important at this stage in the game. And if you can process those things mentally and look at your portfolio, you will rapidly come to the conclusion that you still have a lot of stuff that you bought during a very different environment that no longer makes sense in the morning light.
Yeah, it's a great point that you make and a good way to finish. Josh, I appreciate it. We'll see you soon. Josh Brown joining us there.